Right back at it here on the Financial Exchange. It's Mike Armstrong, Marc Fandetti, and Tucker Silva with you as the markets have a little bit of a negative on the board to start. I guess it's technically the second day of trading in the month of September, but I'm not really going to count the Friday before Labor Day. There's questions being asked, I suppose. We've had a pretty stellar market performance through the first 8 months of the year. If you had taken advantage of that old adage, sell in May and go away, then you didn't come out too well. If you sold on May 31st of this year, the S&P 500, it's up another 7.6% through trading on Friday. So that didn't work out too well if you decided to pass up on the summer of trading here. And I don't think this has anything to do with the timing of the year, but when the markets are up 18% in any given point in time, I think you have to take a step back and ask yourself, okay, well, what's the probability that we continue this pace through the end of the year? I think that's,
Mike, I'm glad
a fair
you
question.
asked, because there are a couple ways to answer that, I guess, and you guys may have other suggestions, or people in the audience might want to suggest rules. But
close your eyes and throw a dart at the wall?
Yeah, that's one way.
Yeah, that is one of the methods.
Just flip a coin. There is some seasonality in returns, but the patterns change.
Yep.
January used to be dismal. Not the case anymore, not at least since, I don't know, like 2000, if memory serves. I've done charts on this and looked at it.
We know, Mark.
It's fun to look at seasonality. And by seasonality, we just mean, are there any patterns? Like, the stocks tend to go up in December because people are out spending and it means good retail sales. They tend to go down in January because people are selling for tax loss reasons, or they're preoccupied, or they're strapped paying their credit card bills. They don't have discretionary funds to put into the market. All kinds of theories explain.
In my case, in a diabetic coma from the Christmas holiday. Yeah, any of those things.
Exactly.
Yeah.
So that's one way to predict. Another way is just to look at the frequency of outcomes when you've hit a certain milestone by a certain date. So when stocks have been up at least 18% through August since 1926, for what this is worth, do not take it to the bank.
I was going to say, how many times has that happened?
This is trivia. It's happened in only 3 years since 1926 when stocks have been up at least 18%
through August.
Again, this is silly trivia, so do not make decisions based on this. But in all but 3 years, and those years are notable. It's 1929. It's 1986, which has similarities to the present year. We can get into that. And then, of course, 1987. And in 86 and 87, stocks both finished up. In 86 by a little bit less than they had been up through August. Not much, a couple percentage points. And then in 87, we all know what happened. Stocks,
I remember that, yeah.
Yeah.
The old flash crash.
Yeah, stocks, I guess you could call it that. Stocks plummeted and then recovered somewhat to finish the year in positive territory. So the exceptions to this little frequency approach to answering the question, what are stocks going to do from here on in, are notable. Again, just trivia.
Yeah. I think that's fair. Don't try and make anything of a 3-year trend. I don't think there's much to say of that.
There is something. There is one substantive point, though. It's not just silly, like cocktail party chatter, which is that there is a momentum in the short term to equity prices.
Sure.
Things that go up continue. You might more accurately call it inertia. It's tough to change direction without a big change in sentiment driven by some type of event or shock. So stocks tend to do what they've been doing. Your best guess of what stocks are going to do tomorrow is always what they did today.
Sure.
Always. Best guess, I just mean most accurate. You're never going to get the turning points right.
And, quite honestly, I hear a lot of critiques about where this market is. There's always a moment, there's always somebody out there saying, the markets are going to fall by 10% by year end. Somebody here, let's see, who did they interview? Shauna Sissel, who's the chief executive at Banrion Capital Management, who, again, I've never heard of, but they are predicting a 10% drop from current levels before year end. And sure, I can absolutely see how that could happen. But I don't see anyone coming out there and coming up with real compelling evidence for why equity markets or the economy needs to fall apart before year end. I think it's fair to say that equities are expensive. I think it's fair to say that there's a lot of people questioning as to why the markets have rallied so far. But if I'm going to summarize it, I think I stick with the same point, which is, there are concerns out there. I'm worried about what's going on with China. But if you had told me that the U.S. economy was going to not lose any jobs, if we were talking summer last year, and you had told me, hey, we're going to get inflation down to 3%, and we're not going to lose any jobs doing it, then I'd have told you you're crazy. And that's effectively what we have done. In fact, we've added a
Okay, so
number
what
of
did we
jobs,
get wrong?
and so I think it's explainable that the markets have rallied.
Why did we think that, and what did we get wrong? And I'm applying this to myself because I would
Sure.
have been in the "you're nuts" camp. You
Yep.
don't get 6 percentage points of disinflation without any economic sacrifice. It's only happened like once. That would not be a soft landing. That would be a Charmin soft. Like I can't come up with a better
No, that's good.
metaphor.
Pillows
That
of
would be
toilet paper.
the
Got it.
softest possible landing.
Yeah.
So, but we haven't landed yet. It would be my contention. The jury's still out. But
Agreed.
it's still a phenomenal outcome. What did I miss? What did people who thought, no, there's going to be some economic sacrifice involved? That's always been the case historically. If you're an econ person, that's what the Phillips curve tells us. There's a trade-off. What did we miss? The power of supply shocks, positive and negative. Early in COVID, this is my story now, and I'm going to stick to it until somebody comes up with a better story. But early in COVID, we know supply was constrained. So supply shifted in a negative fashion. We got hit with oil price shocks when Russia invaded Ukraine and other supply shocks. So we had COVID supply shocks. We had oil supply shocks.
Yep.
Those adversely affected the ability of the economy to produce in the short run. At the same time, we had massive rounds of stimulus. Trump and Biden couldn't get money printed and passed out to people fast enough. Big deficits, jammed people full of money. They had nothing to spend it on but goods. This pushed up demand at the same time. Supply was constrained. That pushed up inflation. Now, in the past year, what's happened, at least on the supply side, those supply chain snarls have become untangled. Those energy price shocks have reversed. We've had negative energy price shocks, which are positive for the economy.
Sure.
Negative in the sense that they're below zero. So two big parts of the drivers of inflation, headline inflation anyway, have reversed. So it's been good luck to a large degree, but foreseeable good luck. There were people who said, no, this is supply shock related. It's going to go in the other direction. And they were right. I think they're wrong in their optimism about underlying or core inflation. That's probably more demand and monetary in nature.
Which
Jury's
is still
out
running,
on that.
4.5% year over year?
You could make an honest argument for anywhere between 3 and somewhere in the 4s, maybe a little higher. That makes me and some others uncomfortable for what it's worth. We'll see. Again, jury's still out on core inflation and how high Fed funds has to go to really get it under control.
On Friday of last week, we did get a jobs report, and for anybody that missed it, given that it was the Friday before Labor Day, it was fine. I'm trying to figure out how to describe this jobs report that we saw. The wage growth was fine. The number of jobs created was under 200,000. It really fit right into that narrative of this economy continues to, I think, just revert back to what we were used to prior to the pandemic. And that's, look, it's causing problems for some businesses who made bets on, the new normal of the pandemic is going to be permanent and everything's going to remain that way. So there are some businesses, a number of retailers that are struggling with this. But to me, this economy is starting to look more and more like the 2019 economy. And I think there are some good things to be said about that. It'll cause some issues in some places, but we're starting to see, at least in my mind, some degree of normalcy in this market, which it's been a lot of, and this economy, a lot of abnormalities for the last few years. A lot of things that, based on economic history, haven't made a ton of sense and have been explained away by massive government spending and supply chain snarls. And I think we're starting to look a little bit more like a normalized run rate economy. Deficits are still outrageously large, but nonetheless, I think they were before the pandemic, and they're starting to look normal again.
But don't forget the concern in 2019. Well, let me go back to 2018 because 2019 there was a growth scare early on. The Fed reversed course, cut rates, sent stocks soaring because that's what stocks like. This to me, I think 2018 and then 2019 before the growth scare is a pretty good analogy, with the exception of underlying inflation right now being a little bit higher, and the worry in 2018 was underlying inflation perking up. The Fed was talking tough and considering hiking rates, indeed did, until the end of 2018 when the bottom fell out of the stock market and they proceeded to reverse course. If you only had the data we're looking at today, you took it out of the context of the disinflation of the past 12 months, you would say, geez, the economy's in danger of running hot. Unemployment's below 4%, vacancies are still high, core inflation is high, wage growth is high. Fed better step on the brakes a little more. That would be your out-of-context conclusion of an economy like this. So in that sense, Mike, I think your analogy of I would just tack on 2018 to that. I think it's a pretty decent one.